Welcome to Talk Tickers, where we break down the earnings calls that move markets. Today we're looking at Agilent, a company that just delivered a stellar earnings report. So why did the market completely ignore it? Let's break it down.
Agilent's latest report presents a real puzzle. I mean, the company absolutely crushed revenue estimates and even raised its full-year outlook. And yet, the stock, well, it went nowhere. We're talking essentially flat in after-hours trading. So the big question is, what is going on here? What did the market miss? Well, in this analysis, we're going to unpack the numbers, dig into management's core strategy, and look at a key headwind to understand why everyone just shrugged, and then we'll give you our call on the stock.
Okay, let's dive into the numbers because the headline figures were seriously strong. Revenue came in at $1.74 billion. That's a massive $70 million beat versus consensus. Now, non-GAAP EPS was just a penny ahead, but really, the story's all about that top-line strength.
And this wasn't just a fluke. The CEO made a huge point of this powerful trend. This was the fifth straight quarter of accelerating core revenue growth. Think about that. It climbed from just 1.2% in Q1 all the way up to 6.1% this quarter. That is what you call durable momentum.
This growth was also incredibly broad-based. It wasn't just one division carrying the whole load. Nope. All three major business segments and every single geographic region contributed to the beat. That's a sign of a really healthy business.
On the profitability side, the engine room is still the Agilent CrossLab group. That's their services and consumables business. And man, is it a cash machine. It posted a really robust 33.3% operating margin, anchoring the company's entire bottom line.
So what's behind this consistent execution? How are they pulling this off quarter after quarter? Well, if you listen to the call, management kept pointing to one central strategy, their enterprise operating model.
They call it the Ignite transformation. You can think of it as a company-wide framework designed to make Agilent faster, more efficient, and just laser-focused on what the market actually needs. It's all about process discipline and commercial intensity.
And the CEO was really clear. This is not just some corporate buzzword. He framed Ignite as a key differentiating growth driver that is delivering real, tangible, measurable results across the entire business.
And the results really are tangible. We're talking double-digit cost savings, a 15% flatter organization for faster decisions, and a pricing strategy that's having double the impact it did last year. It's even helping them navigate supply chain shifts to deal with tariffs.
But, and this is a big but, that amazing top-line strength, all those extra shipments, actually made another problem bigger. It amplified a headwind that helps explain the market's muted reaction. And that headwind is tariffs.
Because of higher-than-expected shipment volumes and some new European tariffs, management had to revise their full-year net tariff cost upwards to $20 million. Now, that's a big jump from the minimal impact they had guided to previously.
But here's the key part of the story. Management presented this as a temporary problem. They laid out a clear plan to adjust their supply chain and pricing, and they said they expect to fully mitigate the impact of these tariffs by fiscal 2026.
And that brings us right to the guidance. See, this tariff issue is the exact reason why, despite raising the full-year revenue forecast significantly, Agilent kept its earnings per share guidance flat. All that extra revenue was essentially absorbed by these temporary costs.
So you have this total disconnect in focus. The market seems to be fixated on the now, the current temporary margin pressure from these tariffs. Our view, however, is that the real story is the clear path to margin expansion in fiscal 26 as these headwinds just fade away.
And based on that forward-looking perspective, our call on Agilent is an outperform rating. We believe the market is completely mispricing the stock by focusing on a short-term issue.
Here's how we see this playing out. 1. The top-line momentum continues. 2. The Ignite model keeps delivering more efficiencies. 3, and this is the big one, those tariff costs get fully mitigated, creating a margin tailwind next year. And 4, the market is finally forced to re-rate the stock as that profit leverage becomes undeniable.
So how could you trade this view? Now remember, this is not financial advice, but here's one idea. A long call spread expiring in fiscal year 26. This is a direct bet on that margin recovery story, capitalizing on the market's current short-sightedness with a defined risk trade.
Idea number 2, a pairs trade. You'd go long Agilent and short a broader healthcare services ETF. This is meant to isolate Agilent's specific strengths, its superior execution, and the Ignite model against a sector that's been lagging. You're betting on the divergence as Agilent's unique drivers play out.
So we'll leave you with this final question. With sustained top-line growth and a crystal-clear path to mitigating temporary costs, has the market completely overlooked a compelling margin recovery story that's set to unfold next year? We think it has.
This is not financial advice.